Okay. Happy holidays to everybody. Get this started here. It is December 30th, 2014. And who says that you can't make any money at the very end of the year? We've got a real nice trade going on with Euro Yen right now. And I want to talk about, we'll look at that Euro Yen trade here in a moment. I want to talk about the dollar in general. It's no secret the move's quite extended, and the euro, for example, while the euro I don't think is going to be the best play, I think the better play on a dollar pullback, if you will, is probably going to be the Aussie dollar. Okay, you can even see it today. The Aussie dollar is turned up fairly sharp from the lows, and we'll be watching for support probably near 81.40 to 81.50. Kiwi dollar, of course, too. But I just let's consider a few things here when it comes to the dollar and correlations and whatnot. Okay, so this chart is of the dollar yen in black, okay, and we've also got the S&P 500, or sorry, this is actually the Dow. I did the Dow because I wanted to look back further, more data. The Dow in blue, and you can see the correlation. Actually, it's actually 1 right now, which is a 13-week correlation. So I ran this over the weekend, and I was going to make this the new chart of the week, but since last week is kind of like a half week, and this week is like a half week, decided might as well save this for the beginning, the first week of 2015, and make it kind of a chart of the week, because it really, I think, conveys something extremely important. Again, after last week, the correlation coefficient, okay? Correlation coefficient is how you measure correlation, so it doesn't mean that, it's not right to say it's the correlation. The correlation coefficient was 0.85 for these two over the last 13 weeks, so rolling quarter. In this case, it's the fourth quarter, basically, because we're looking at the last 13 weeks of the year. But you can see that that's what the red dots indicate. All right. Now, in the history of dollar yen, going back to the 1970s, the free floating, freely traded rates, and the Dow Jones, you've only had periods like this where we've had this high of a correlation, on several occasions. One was the 2007 at the top, and then throughout 2008, culminating in October, late 2008, October, November 2008. That's really the last time that we had this type of a correlation. And then we did have it for periods as well in 2001, after the kind of the tech bubble burst. Okay, so what's super interesting to me is the fact that you have such a high correlation with these markets, both rallying significantly. Okay, high dollar yen and a high S&P, high Dow Jones, and you hear it all the time in the news, that, or other analysts or major mainstream media, what you'd hear about the risk on, risk off trade. Okay, well, this actually gives some backup to that data. Right now, it really is risk off, risk on trade, because they are so highly correlated, okay, especially since October. Okay, it's been a straight shot to the upside in both with literally no pullback. All right, so this tells you when you have a markets that are this highly correlated, tells you a few things. One, that you're at a point where I think the market's super crowded, okay, and saturated, and the risk of an unwinding is particularly high because the interest is not very spread out, right? Not really a whole lot of diversified bets out there at this point. At this point, it's pretty much long dollar, long U.S. stocks, and you short yen, okay? So this is something that we'll, look to profit from heading into 2015, and something that we already are profiting from actually with the euro-yen trade. Currently, we're out of half of that trade, but we're floating about 190 pips right now on the other half. So, when this starts to come off, you're going to get quite the washout. Now, it's interesting. Let's just, for fun, we don't know how the week is going to end. Let's just see what it looks like when we have correlation coefficients of 1, sorry. So the last time we had correlation coefficients of 1, it's actually the only time we've had correlation coefficients of 1 in dollar yen and the Dow Jones was in 2008, and then of course towards the end of, or periods of 2008 June, and then the end of 2008. So it really is all the same market at this point. Okay. Now there's no guarantee that this will stay. If dollar yen, for example, closes down the week and the S&P 500 or Dow Jones closes up, that would change this probably back to 0.85 or less. So we'll have to see. But as of last week, it was 0.85. So again, this is a huge warning flag that the markets are this, tightly correlated at this point. And you can see the same thing actually for if I put up the Dow Jones FXCM US dollar index, we also have a correlation of 1 right now. That has never happened. Of course, this has only been around, the US dollar index, the Dow Jones FXCM one has only been around, excuse me, for for a number of years, and the data only goes back to the turn of the century. But the last time we had correlation even close to this was at the very near the top in equities here, okay, and at that point you had a rebound off the lows in the dollar. Okay, you can see the same thing with the euro and the pound actually. Point being here, folks, is that the dollar and the stock market it's extremely heavily involved in. And on that note, I want to bring forth one more chart here. And this, I put this in the post last week. But we've got I don't have the updated figures, I guess, yet for the COT on this, but the black line is small speculators, okay? We often look at, this is the COT report, we often look at the red line being large speculators like hedge funds, and then the blue being commercials, okay? And the commercials are really the commodity users, if you will. Okay, so you can think like for an agricultural commodity, that might be a food company or something that needs corn to make their product. For the dollar index, this might be national corporations that need to hedge against the dollar or whatever. And in this case, we've had it for some time. You know, the extreme here was actually reached in October. The dollar has continued higher. Interestingly, though, small speculators, which when they get one-sided are almost always on the wrong side, they are at a record long position here as of a few weeks ago. Okay, the two previous records obviously were in May of 2013 here, and then October of 2011 right here. Both preceded, you know, extremely sharp declines. Okay. And then if we go back to some of the other charts that we've looked at or that you're familiar with, let's look simply at, why don't we just look at, you know, some median lines and some pitchforks here on the U.S. dollar index. This is the ICE, okay, Intercontinental Exchange U.S. dollar index, and this this parallel structure or median line structure here from the 2011 low up to the 2013 high off of the low from this year, we've actually reached, and we are making a key weekly reversal the last day of the year right at the upper parallel. Okay. So Petru here had a question asking, I don't know if you'll be covering Euro dollar session. I want to ask if you think that we made a low in euro, or we should look for the 1975 low final target. Well, look, based on this and based on how the euro has reacted down at you know, the zone that was identified as 121.10 to 121.30, low is 121.24 today. I actually think that we get a bigger bounce from here. Okay, but I'll preface you know, this with, or follow up with that on the fact I think Aussie is going to be the better trade. Okay, and maybe even dollar yen on the downside. Okay, but if the trade's there, it's there. So again, making a weekly key reversal right here at the parallel for the dollar index. And look, the you know, what you would be looking for at this point after you come up, you know, as per how to, you know, look at these longer term parallels or any parallel for that matter, median line structure. Once you come up and you hit the upper parallel, oftentimes you look for a return to the median line. Okay, so that would obviously be quite a pullback if we were to do that, and I bet you it lasts 3 to 6 months. Okay, it's going to last a lot longer than people think. It typically does. So we'll let that unfold. But this is definitely going to be worth, you know, following this median line here. I mean, you've got a lot of touches on it. Okay, very close to this gap here. We even consolidated around it and before the last leg up here from the October low. All right, and we'll be looking for a pullback, you know, from up here. Okay, so why don't we then take a look at the euro? So here's the euro. For whatever reason, some of my daily and weekly charts are not updating in real time. Strange, but you know, there were two slopes that are really important to follow at this point. Obviously, there's this one. That's the line off the June and October lows, which was extremely useful in finding shorts up until December. And then there's the line here that extends off of the May and June highs. Okay, that center line right here also, you know, is kind of the breakdown level, if you will. Back in September, you had a gap here. It's actually never filled, believe it or not. And then those are the parallels that I've got extended down here. Okay, and that level was reached today. Okay, so I'll get rid of this to make it easier to see. But that level was reached today. You know, basically right on the nose. Okay, so that level is reached today, along with, of course, 121.30 that we had talked about. If we look at the momentum for the euro. We had this huge cluster. I talked about this last webinar a couple weeks ago. We had this huge cluster of divergent lows. And for me, the only time I'll pay attention to divergence is when you get RSI, obviously the higher RSI, but the RSI's got to be above 35 for me, 30, and then 35 is even better. And then on the highs, you want to see it below 65, but definitely no higher than 70. Okay, so if we look back to the times that we've had these types of clusters, and I don't mean just like one or two. What I'll do here is I'm gonna get rid of some stuff so we can really see the the signals. So I don't mean like one or two signals. I mean a series of divergent signals. In this case, we have 4. Okay, in the last month, 4 throughout December. Okay, so the last time you've had that many, well, we had a series of 5 in March of 2013, and that preceded quite the move higher. Okay. We had only a series of 2 back here in 2008. We had a series of 3 down here in 2005, and that was in November. We got a good low there. Look back a little farther. You had a series of, you had a whole bunch of them here throughout March and April of 2004 before you got a turn higher. And you had a series here in March of 2001, got a minor turn higher. Obviously, the decline that's happened back here is nothing to compare what happened back in 2000 or this year so far. And then, of course, during the bigger bear market of 1999 into 2000, you got a series of divergent signals, which did give way to some bounces along the way. This would have totally failed here. Okay, so this divergent signal would basically be erased if RSI were to get back below 30. But as long as it's holding, look, I still think there's risk on the upside. And if it does fall apart, then great, we've got euro yen on the short side. But for me, the weight of evidence with the momentum, the levels, all the stuff I just talked about with the dollar, the media, kind of sensationalizing that story, if you will. It's kind of the textbook definition of a sentiment extreme and beware a reversal. So, as far as putting a swing trade on, you want to see a base form. You want to see the market probably trade up into, the 122.20 area, 122.40, and then you'd look to buy somewhat of a pullback or something. Okay. Why don't we get into ways to play this thing now, though? So here's the Aussie dollar. This was last night's chart posted during the Petru says, great insight. Thank you very much. Absolutely, my friend. You are more than welcome. So here we have the Aussie, okay? And yeah, I admit, Aussie, has been consistently not necessarily tanking for a while. It's been just kind of dripping lower. We have made some records here with the Australian dollars. We have with a lot of dollar pairs. If you look on the website, you look at, let me bring out hold on. If you look at the website here, if you go to resources, you'll see extended advanced decline, right? So the extended advanced decline, it's very simple reading. It's the indicator based on the risk, the current period's closed and the closed 4 periods ago. Okay. Jonas here has a great question, which I'm going to get into. What's your best swing indication when looking at price, like a head and shoulder formation, higher highs, higher lows, etc.? Yeah. So I think for me, real quick, Jonas, it's probably just a change in the market's behavior, and there's 2 ways to look at that. One really is obviously median line analysis when you start breaking some levels. And look, I got tripped up on that with the euro. And then we tried to buy, obviously, after FOMC was stopped out with that. But the biggest is a change in behavior, which is displayed by either median line analysis and a break of a reaction line, or a momentum change. And the 240-minute chart's probably your best bet there as far as a momentum change, and I will get more into that in a second. But so we had the extended advanced decline indicator, right? Well, I want to show you, I'm going to show you the Aussie dollar, okay? Because what I'm going to show you is going to be, maybe kind of blow your mind a little bit here. So, okay. All right. So first of all, the Aussie dollar is one. We just had a big. This is a DeMark buy signal. If you're familiar with what DeMark indicators are, it happened the day of the low actually. See it right here. Now these don't always work. Obviously, you had some. You look throughout history, and they don't always work, but this year they've worked pretty well. You had a sell on the high day of the year, and we actually got one here on the low day of the year. So I'd say it worked pretty well here the last couple days. Of course, trading these things is a whole other thing altogether. So we just had okay, 27 in a row. So we just had 27 days when the market closed below its prior close. Okay. Let's see if we can find a period in which that has ever happened. Okay, so there's our little magenta signal right there. I'll make sure that I have this data going back far enough. I can go back for 50 years. All right, so right here, nothing, not even during the 2008 collapse did we get something like that. Okay, nothing. Back into the 90s, nothing. This is when we started freely floating. The currency started freely floating right here. Okay, 1983. There are periods of exchange prices before them, but it wasn't really freely traded. Okay, the only time that you can get anything with the data would be back in 1975, but that doesn't really count because, again, the market was not freely floated then. For fun, just to tell you how extended this is, in 2008, the most we had consecutive down closes with an extension like this was actually 24 days. Okay, no, sorry, 23 days. And as you can see, when we had that, we even had about a 300-point rally before the market continued lower. So there's a lot of fuel here for the Australian dollar to head up towards at least 83.75 or so, as I've written in recent posts. So what I think is going to happen with the Australian dollar, again, this is the post from last night. We actually just traded into this level, the top of this resistance. I've been kind of highlighting it all morning. I did take a short on the close of London at noon. It was at about 81.95. I had a 10-pip stop. hold on for 1 second. Sorry, real quick. Okay. The market's traded into that. I did take a short with about 10 pip stop and just got out of half of it right when I started the webinar. Look, it's possible we go to a new low. For me, the weight of evidence favors looking on the long side from any dips into 81.40, 81.50, even though this is at resistance. Why? Well, the things I just talked about. 80.50 is still that huge long-term level. Okay, but this is a nice turn higher here. Okay, right from after a series of consecutive lows, reward to risk I think is definitely on the upside, and that doesn't mean that you have to put a loss in it. Like when I put in, say, an order for on the swing page or the swing timing updates, and I'm looking to go long at or an order to go long, say at 81.50 on the Aussie dollar, and there's a stop at 81. Look, that at times that stuff's going to work, but the better way, if you want to have real success, and you really want to, try to make money and minimize losses in this market, I think the best way to do it. So here's like an hourly chart, okay? The best way to do it, one, you want to know when the tendency for markets to turn is, okay, within the day, and that's at the close of sessions, okay? So, close of U.S. session at 5 p.m. New York time, close of London session at noon New York time are the two times that I'm most likely to make a trade. So when I'm coming into this, I'm like, well, we're at resistance. I'm going to, go short after this thing closes. We have a nice upper wick here. Show the 15-minute chart. We were starting to put in some wicks up here. You can call them pin bars if you wish. I like, key reversals, whatever. And then you put a 10 pip stop on. You can go 10-to-1 leverage and risk 1% when you have 10 pip stop. Okay. And it's not like you're doing it random. Again, we're talking about doing, specific times. Then when you get, a pullback, say into support, at this point, support was right here. That's why you got out of half, this former high. What you're doing is you're taking off a good portion of that, locking in, say, a 1.5% gain for the day, letting the less run into the bigger support. Okay, so when we look at here the hourly chart, and Jonas, this is going to speak to your question specifically about what's your best swing indication when looking at price, like a head and shoulder formation, higher highs, higher lows, etc. Well, look, we've got here the high, okay, a pop, a new decline in this rally. Best indication is going to be a change in behavior. In this case, you can actually see that we can draw an upward sloping trend line. Okay, and we held it last night. This was last night about 11, 12 o'clock or so in New York time. And then what you're looking for is simple support. Okay, what's been an important level here in the Aussie dollar when we look back? I'd say roughly 81.40 to 81.50, right? We can see just real simply, 81, this whole area here, right? You've got, consolidation here before it breaks down back here, right? So this whole level, 81.40, 81.50 has been pretty key. We're going into a holiday here where we've got New Year's Eve today or tomorrow, and then New Year's Day. FXCM will be closing tomorrow at 2 p.m. just like they did on Christmas Eve. And so trading won't resume until Friday at I think 1 a.m. Friday. So heading into the market with against, say, a trend, might be a little dangerous, of course. There is precedence, of course, for the market to reverse higher out of a trend too, specifically November 2011 Thanksgiving. The New Zealand and Australian dollars opened up something like a couple percent, then pulled back and continued higher. The gap for Kiwi still hasn't been filled back then. So as far as putting it in order like today or tomorrow to go long down here, probably not going to suggest that. But bottom line, watching for support, especially if the market reaches 81.40, 81.50 at this line. Okay, now let's take a look at the momentum for the Australian dollar. Okay, I tend to go most by the 4-hour charts when I'm looking at momentum. It just kind of fits the kind of positions that I want to look at most. I find it to be fairly reliable. So first, a few things on this momentum. Just so you know what you're looking at, these are RSI trend signals that I kind of developed, and it basically, the big red dots are kind of sell the rally signals. The little blue dots are divergent warnings. You might get a bounce. The blue dots are buy the dip warnings or buy the dip signals. I don't take every single signal blindly, obviously, but it's nice to see when you have things lining up in your favor. So a few things have happened here with the Australian dollar in just the last week or so. One, deep oversold. Okay, that happens typically in the middle of a trend. But since then, what's happened? New price low. This was FOMC right here. Okay, FOMC right here. FOMC, Brendan's got a great question. I will get to that in just a sec. Here's FOMC bar, new low, but look what happened to RSI. It wasn't even below 30. Okay, that's a good sign if you're looking for a low, that is. Okay, now what happened down here at the low that we got just before Christmas Eve? RSI was actually close to 40. That's the sign of a very petered out market. Okay, and then what we also have, and just as important, is we've got RSI sell signals here, which have now been broken. Okay, so that puts in a swing low here for me. Okay, it's say 81.23. Now, I just had a great question from Brendan asking, how would you incorporate LEWA principle into the Aussie dollar trade? Great question. So here's another thing real quick. This is the hourly version of that chart with the signals, and you can see we've started to get RSI buy signals now. RSI buy signals, getting RSI buy signals down here, really for the first time, since here, which would have totally failed in November, but the first time that are starting to work out until, early to mid-November, okay? So very important that we hold this low, 81.21, if this thing's going to go back up towards the 83.75 area or so. So how would I incorporate? That's a great question here. So why don't we let's go with a naked chart. And we'll do some wave counting, if you will. All right, so .8, let's go back 8 months. All right, so this was the top back here for the Aussie, okay? You can count 5 down here. It's ugly, but whatever. Give it a 1, probably with truncated there. Okay, 3 waves up, 3. Your strongest part of the decline, 4. Or sorry, what am I talking about? 3. You might think I'm getting my numbers all mixed up, and no, I know Christmas Eve is tomorrow, or New Year's Eve is tomorrow. I have not been drinking yet. 1, 2, 3. Okay, 4. So zigzag, flat, and then this being wave 5. 1, 2. This is probably 3 down here, 4 and 5. Okay, and the former fourth wave for Aussie is 83.75. Okay, so what we're looking at as far as we're looking to get long for what's probably just a move up to 83.75. I say just a move. You know, if we can get a nice entry near 81.50 at some point, 81.40.50 with an 81.20 stop, you're risking 20 to 30 pips for, you know, a couple hundred. I'll take that any day, right? So this, you know, kind of lays out a path going forward of, say, a pop higher, a drop to a new low. Again, we're going to keep focused on 80.50 and then the big low. And as far as finding where the next high comes in, it's probably going to be somewhere along this line, just because that's how channeling often works. Waves 1 and 3 extend a parallel from wave 2 will often get you, you know, the end of wave 4. And that's, this slope, by the way, is really close to the slope that extends off of the August and October lows. So that's quite useful. If we want to throw in a little more Fibonacci, you know, where's a 38.2? 38.2 happens to be very close to 83.75. Okay, 83.58. So that gives you a nice, nice level. Look, maybe we get a gap higher or something after the New Year's and do a fourth wave high. I'm just kind of speculating here. And then, of course, why is 80.50 such a big deal, right? I talked about it being 2 equal legs down. Well, 2 equal legs down from where? It's 2 equal legs down from the high of the year. It's divided by wave 4. So sometimes wave 5 does equal all of waves 1 through 3. That would be right here, 81.48. Okay? So it's quite possible that we do go to a new high, probably somewhere over here. Okay, and then we end up getting a new low in wave 5. So that would be the Elliott wave model for the Australian dollar at this current juncture. And after you got down towards here, you'd be looking for a really big rally, potentially all the way back up to 89. All right. We're going to take things as they come, of course. Okay. And the next position for me is going to be looking at, again, that 81.50, 81.40 to get long, you know, for the bigger swing on the upside. You know, and I'm sitting here saying that as I have a small short position running with an 82.05 stop, and I'm already out of half of that anyway. So bottom line, looking a little lower, looking to get long, stop down here. Hopefully it turns quickly in your favor. Then you can go to break even. That's the name of the game. Let's look at the seasonality chart, actually, for the Aussie, because think about what I just said. Talking about this possible, you know, getting a little pop here, right, in wave 4 of 5, and then getting a new low early in the year at some point, and then getting that big move. And hell, I'll look to play all 3 of these things, okay? As long as the pattern keeps playing out, you know, stay on track and whatnot, you've got reaction lines to trade into and whatnot, then let's do it. But there's another, you know, piece of the puzzle, if you will, and that's the Aussie dollar seasonality chart. So we're going to go into the new year, and this chart will change slightly, but not that much, because the seasonals actually were pretty useful for most of 2014. Okay, so, you know, again, the magenta line is what the seasonal average is. Okay, I should say the seasonal tendency. And this is going to be, we're going to switch over to 2015, of course, and we'll start back again over here. Okay, this line will get superimposed back to the right. So what you're looking for is really the first week of the year in Aussie. Seasonal tendency is actually pretty strong. Okay, and then you're looking for some weakness. Okay, and then you're looking for a much bigger rally. So that fits the the idea of a rally in this small wave 4 of 5, and then a new low in wave 5 of 5. But that completes wave 5 waves down from the high up here, and then you get the risk of a much larger move to the upside. Right, so this is all combining to tell a story. The Elliott waves, the reaction lines, the momentum signature profile, whatever you want to call it, and then of course the seasonal tendencies. So things are lining up very well. Now, I think my favorite, one of my favorite setups heading into next year is probably Kiwi. And look, been awfully hesitant here in the last few, weeks, and I guess really shouldn't have been. Remember, we were tracking, I know there's a lot going on here, but we were tracking, we've been tracking this Kiwi for a while, looking for, reaction lines to hold, and for a C wave of either a triangle or a flat to head higher. So you still want to buy weakness on these lines. Okay, at this point, it might be closer to 77.40 than 77.20, but things are still setting up to get long. Okay, the Kiwi dollar. Okay, for a move again for at least 79.10.40 and potentially even higher than that. Obviously, we look at the seasonals for Kiwi; they're going to be fairly similar to the seasonals for Aussie. And again, these will not change a whole lot because the seasonals did fare pretty well in 2014, with the top here in early January, okay? The top, of course, came a little early, but the top in the week seasonal period throughout July, although it overdid it much more than I thought it would. So when we look at the Aussie dollar, or the Kiwi dollar, and we look at, let's see where January 10th comes in, or it's January 9th, I guess, would be a Friday next year. Hold on, check my calendar. January 9th is, okay. So when we put that up, the seasonal top could come in. That does line up really well with several different reaction lines and confluences up around, again, 79.10 to 79.40 region. So that may be offering a sell. Of course, in the meantime, am looking to buy any weakness down towards supports. And once you get a market turn like this, it's really useful. I know I've talked about this before, but it's real useful to put up. I look at two averages on an hourly chart. I look at the 24-hour moving average and the 120-hour moving average. 24-hour obviously is a day. 120 hours, 5 days. Okay, when you get a decent trend, you're going to pretty much follow those averages. So, follow the red. The red is the 120-hour moving average. So if we have a strong trend higher at this point, I will be, keep that 120-hour moving average on the Kiwi dollar chart. Let's see here. Make that 120. Okay, 120. All right, so might want to follow that 120-hour moving average, okay? If you start to come off a little bit, this thing's going to flatline a little bit, and maybe actually it ends up near 77, 50, 60 or something, you know, towards Friday or Monday, and that would be the long opportunity. But also look at if you draw this fork, okay, going off this low to this high and to this low here, okay, and this is a shift, meaning it's shifted 50% to the right in time, and you have, when you do that, you get the same trend line as you would from the low to wherever you draw the second one right here, okay? Same line, you can see that. So we just got the top here on that line. So, you know, that's interesting, and that kind of tells you that this is the right structure to look at, I think. And, you know, we hit that here too. So we'll be definitely following this going forward throughout January, most likely. Okay, so that was Kiwi. Thoughts on the long? Jonas is with a question. Some nice comments here, guys. Very appreciative, of course, of the nice comments. Thoughts on the long side of pound Kiwi closer to 9750? Sure, let's take a look. You know, I did just put up, and you made a comment, Jonas, at the beginning of the webinar about, yeah, the 2 equal legs down in pound Aussie. And yeah, you got that. Again, I would still, you know, I'd still kind of keep an eye out for 89.45. Just this low here, also the lower parallel down here. You know, so it could sneak a little bit below that level. But in general, you can kind of envision this setting up, you know, a bigger short opportunity as you come down here and then kind of get a pop and makes, you know, sort of a rounding top / head and shoulders pattern, whatever you want to call it, okay, for the pound Aussie. But let's look at pound Kiwi though. Long side closer to 97.50. So first thing that really sticks out here to me, Jonas, is daily reversal support. And that is going to be right there at 97.32. Then you've got the trend line, which goes back, well, all the way to the 2013 low. And then, of course, crosses through the low here in September, pretty close to the low in November. So, yeah, it could be certainly a possibility. In fact, again, you know, it's kind of odd because tomorrow is New Year's Eve and everything, but 97.32, this daily reversal level, actually does intersect, you know, tomorrow, the trend line. And then let's see if we got a short-term fork on here too. Not necessarily, because it would, if it got down there, it would be lower. But yeah, I'd watch for 97.32. You know, I'm more of a fan at this point, I think, of, at least lately, the way market conditions are, with the market being so dollar-centric, to kind of play the dollar legs. In other words, you know, looking for, you know, in this case, you have long pound Kiwi. So what you'd be looking for is basically short Kiwi, right? Because that's Kiwi is the much higher volatility, higher beta leg. Okay, so Kiwi's going to affect this much more at this point. And you know, I think that's the right place to be looking for a short-term trade, Jonas, because again, we have pulled off, right, this level here, the median line. So we'd be looking for weakness into support, as mentioned, just a little lower. But yeah, I think you're in the right place. But yeah, close to 97.50 and 97.32 again, daily reversal support. So it's a big level to watch. Why don't we? I want to take a look real quick at the yen. So posted this earlier. Amazingly, dollar yen stopped right at its daily reversal resistance. And again, for those of you unfamiliar with it, check out the resources page. We explain what it is. But it's the high period close or the low period close. And I think it takes on more weight if it's a reversal bar. In this case, obviously, 1208, December 8th was a reversal bar. And the close of that 120.68, we kind of, tool around up there for a couple days. Then today we've come off sharply. The support zone identified was from the month open of 118.72 to the high back here, 1120 high of 118.97. Today's low is right on there, 119.86, right between the two levels. So we are at support. And for that euro yen trade to really go, like to get to 142 or something, clearly we're going to have to break, dollar yen has to break this big level. But, this is actually a pretty good sign. You have the month open here. That means we're going to close, barring something big rally tomorrow or whatever, we're either going to have more or less a monthly doji on the dollar yen because we're going to close very close to where we opened, or we're going to have a reversal if we have another down day. So, it's things I think are lining up fairly well for, possible euro yen continuation. And on that, to measure the euro yen possible target, I just measure it like this. I measure the smaller leg of the supposed head and shoulders pattern, and you can extend it from the breakout point, which would be here. That gets you a target all the way down towards 141.75. Obviously have this high here at 141.21. So, 140.76 to 141.20, kind of a target zone for the euro yen if indeed it does fall apart. You've got the 50%, from the low here, October at 142. For me, I will be more closely following, this median line here. There's a pretty nice confluence very early in the year, right near 142.60. So that might end up being a final target if things play out. But bottom line is still looking lower for that euro yen. Okay. Alrighty. Dale, Happy New Year to you guys and your family. Thanks for the euro yen short. 172 pip profit, the most I ever had in one trade so far. Thanks again. That's awesome. Good to hear, Dale. And Happy New Year to you and yours as well, my friend. All right. Let's see. Are there any other questions that you guys want to get to? I'll have an update. Obviously, I will put this up, archive it, because I'm a veteran now at these things, and I'm good at hitting the recording button. Pound yen, sure thing. So pound yen, not as clear to me as euro yen. Again, euro yen, we have that topping pattern. Pound yen, we don't necessarily have that topping pattern yet. So that's, kind of trade what's cleanest. This was, I haven't looked at pound yen in a while, so this was one that I looked at back in, I guess probably mid-December or something. And, we had, just didn't work. I mean, you retested here and then we went well above it. But if you're looking for levels on pound yen, one. Always pay attention to the daily reversal levels. In this case, got one here, 183.31. Always want to draw the, I'd start with SHIF just because that would be the trend line off of here. It makes a corrective channel. Give yourself a fib. 61.8 of that actually comes into play roughly tomorrow, so I would watch 184 for support if you get it. So that's pound yen, Emil. Yeah, I would be looking for 184 for support, basically down on this line here tomorrow at some point. 184 area for support. As far as resistance is concerned, just the former, I'd look at the former low here, about 186.50 or so. Garrick asking, what about euro-yen resistance? So good question. So one thing that you might want to do is follow the 24 and 120 period moving averages, okay? Especially if they line up with the former low. So, for the former lows are coming in at 145.90 and 146.40. So that gives you 145.90 to 146.40 is going to give you resistance to look for in euro yen. And if we draw fibs here, the 50% comes in pretty close, obviously, to the former low here at 145.90. Okay, so it's impossible to say where the next top is going to be in anything on any certain time frame. For me, this is a pattern on the verge of breaking down, or it's going to be a false pattern, and if it is, we're not really hurt by it. We've already gotten out of half anyway, but would be looking for resistance additionally up at 145.90, 146.40. Now the question you have to ask yourself now is, where are you wrong, right? And really at this point you have to be wrong at 147.20, so I'd stop till 147.25. This goes right into the question that Dale just asked, leverage and trades. So I kind of touched on it a little bit, but I know when I'm really stalking an idea, and you could tell, I think by on the SB Squawk, just how often or how much I was, talking about the euro yen, right? So we had a lot of things going on for the euro yen. The original, way that I thought it was going to play out didn't necessarily work, right? We had this median line structure, okay? Now the market responded well here, okay, but then we went up above it intraday. Now you don't get rid of it. It still may very well come into play as resistance in the future. In fact, what you want to do is you want to add a parallel here, okay? That might become resistance. So, you could be getting resistance up here at some point, very early. That would actually be on Friday, okay, right here at about 145, 146.40 or so in this level, okay? So that's where you're, I think, probably going to be looking for resistance. But when you have an idea that you're really stalking very closely, the trend lines, the minor breakout here, what I mean is that the market traded above these levels. And it was almost, if you think about it, it was almost like too perfect, like a breakout, this way. And the market, the momentum is exceptionally low. So it's nothing more than just a little trap, I think. And then also, with the 20-day average, okay? Here's the 20-day average right here. The market had broken that 20-day average. you know, treaded sideways, and then we tested it. Okay, so as we were testing that 20-day average, and we were sitting right on this line, and we had the hourly doji right there, you know, closing at 147.09, trading up to 147.13 just after the hour, having the high at 147.21, putting that short on at 147, you know, 10.09, whatever you got in at, when I put it out, that gives, with the 147.25 stop, that's a 15 pip stop, right? And if you want to risk 1% on a trade, and you have a 15 pip stop, and these are yen pips, right? So that would be 12 regular pips, right? 15 times 0.8 would be 12 regular pips. And if you're risking 1% on a trade, you can basically go 9-to-1 leverage on that, because that gives you, you know, you're risking at that point, you know, 0.98%, right? 12 pips, $12 pips times 9. Okay, so that's kind of what we were looking at. That's, you know, the best. That's how to use leverage, in my opinion. The tighter the stop, but not just because it's a tight stop. It's a tight stop because it's a good setup and it's the right time, and it's, you know, you have a high confidence, I should say, in the trade, because there's so many things there. And those don't come along all the time, right? But that's how you use leverage. So if that's how you're going to make your money at the end of the year. You know, those high leverage trades where you have a 15 pip stop and you can go in at 8, 9-to-1 or whatever. If you want to risk 2%, you can go in even more than that. I prefer to stick to the 1% trade unless something is, you know, absolutely insanely sticking out in my mind, and let's hope we have some of those coming up this year. But, you know, that's how you do it. So that's how I use leverage. Okay, you get those rare opportunities when you have 15 pip stop, and then you can really go in with only risking 1% of your account, right? But, you know, the market falls a couple percent, and now you've made 10% on that trade. Okay, now for me, I'll scale out. You know, originally, you know, scale out of some. You know, as you get, you know, a deeper decline on a short term, because you have no idea if you're going to continue to break, get out the first support. That might be the 24-hour average, whatever, and then let the rest go. The target I'd put out on the swing position, of course, was half of it at 145.60, because that was daily, you know, daily reversal support. And the rest, you know, let it go because it could be a breakout, and we just talked about the targets being a little lower. But for pulling your stop in when there's a tight stop, Jonas asking, do you have criteria for pulling your stop in when there's a tight stop? So I mean, I guess you mean like by tightening it. When it comes to tightening the stop, break even, right? Well. It's not like it's definitely not like a system, you know, rules-based system with strict, you know, rules. The best thing you can do is be strict about how much you risk, of course. You know, at this point, you could probably move the stop to 147.10 to break even, but, you know, keep it at 147.25. Let's just say let's base it on kind of swings. If you get a failed rally, right? We haven't really had a failed rally yet since the short. It's been kind of a straight shot to the downside. So let's say after you get a failed rally and the market then heads lower and starts to break the lows, then you move the stop to the next swing high, whatever or wherever that may be, if that happens. You know, I think a better example is probably to look at might be the Australian dollar. In this case, you know, because we are going, you know, against the larger trend, but looking for a larger pop up to that 83, 60, 75 area. If we get that support and we get in that 81.40, 81.50, our stop's already really tight, right? It's 81.20. A 20 pip stop risking, that would be, 5, leverage of 5. If you were to get in with a 20 pip stop, 30 pip stop, it'd be, 3.3. And the market turns up, I think it's probably better, to take some off at whatever the resistance may be. If it was 81.40 you got in, you might see resistance up at, 81.60, 70, just hypothetically, take some off there and then leave the stop where it is, okay, so that you're awash on the trade if you get knocked out of the rest of it, but you're also giving yourself more of a chance to stay with the trade than aggressively moving to break even, because if the market fools around down here at support, might wick down and then kind of take you out. Okay, all right. Garrick Wynn, yeah. So Garrick's asking about setting up orders or a different account for trades, I guess. Yeah, it's something we'll look into. It's a good point you make, Garrick. So we'll definitely look into that. I'll talk with Mike and see what he thinks about it. As far as the trades are concerned, or the trade alerts. All right. Okay, guys. So thank you so much for attending. Going off with a bang here in 2014 and looking forward to an exciting, profitable 2015. And we will have an update for you later. I'll have this archived. I'll have a pretty small update, because after today there's not going to be another update until Sunday, with the New Year's and everything. So Happy New Year to everyone, wherever you may be, and talk to you next week. All right, take care. Bye.